And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking. ABSA is a proud lead sponsor of B20 South Africa 2025. Good evening. Welcome to the program. I'm Stephen Grootes on a day which I suppose will be remembered, money speaking, for the new figures showing that our economy grew by just 0.1% in the first quarter of this year. And I have to say, when I heard the figure, when I saw the number for the first time, I didn't feel angry or frustrated. I had more of a wary disappointment. I've been working in radio in this country for a little while, and all of that time, I've pretty much been involved in conversations around how do we grow the South African economy. It goes on and on and on. I sometimes think we're in some kind of bizarre loop, almost sort of nightmarish loop. I must just say, and let me just make this point before you speak to someone who's a lot more, before you hear from someone who's actually a lot more academically qualified than I am, whatever we're doing, whatever we think we're doing, whatever we say we're doing, it's not working. And when we have a government that keeps saying this is our, what's the phrase, apex priority, whenever we have someone saying, no, we're going to grow the economy, we're going to do this, we're going to do that, you hear nothing. I must say, I'll probably need to do a more thorough check, but I have not heard anything from anyone in government to this today. And how often, whenever we have unemployment numbers come out, we hear nothing, virtually nothing, from the Department of Labour and Employment, very little from anyone else in the economic cluster. And this has been the case for a number of years. So, wary disappointment, I'm afraid, from me when it came to our numbers. We'll talk about that more in a moment. Also, more, of course, on the foot and mouth outbreak, strangely in Gauteng. I say strangely because so often you have foot and mouth outbreaks, often in Limpopo, often in the Eastern Cape. Very difficult to control foot and mouth. Not quite as bad as avian flu, but it really does move very, very easily. But in Gauteng, quite rare, and particularly I would suggest at a company with the name of Karan Beef. So their problem is in Heidelberg. More on that in a little while. I would recommend that you stick around for Personal Finance tonight. Warren Ingram's going to be talking about the things that destroy your wealth. I'll give you a very small hint. A lot of them are cars, and we know that happens. So just stick around for that. There might be some nuggets in there. You might want to send that on to someone who you think who needs to hear it in a podcast later. 011 883 0702 021 446 0567. What would you do to grow the economy? Voice notes as well this evening on 072 702 1702.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, more proof today that our economy is not growing, that it's not creating jobs, and I suppose perhaps that we're not following the right policies to grow our economy. Stats SA reporting our GDP grew by just 0.1% in the first quarter of this year compared to the last quarter of last year. Load shedding, a lack of demand for water, and lower platinum prices all helping to bring the economy down. Agricultural production, though, up by 15.8%. That helped to keep our economy from actually shrinking. Ndumiso Kubeka is the chief economist at KH Research Equity Partners. Ndumiso, good evening. Thanks for your time. This appears to, again, be more proof that our economy isn't working. Whatever we say we're doing to grow our economy clearly isn't working, and whatever we think we're doing the wrong thing.
Well, certainly, Stephen, it appears that whatever efforts that are being made are not necessarily moving the needle to the extent to which our economy requires to. And I think perhaps it should be associated to the extent to which we have a proper, credible plan to actually grow the economy. Now, of course, we've had the National Development Plan, which has a target of 2030 in terms of what South African society and the economy should look like. And in February, after the Budget 1.0 was tabled, Cabinet then approved what was then the Medium-Term Development Plan, which in my view at the time, at the tabling of Budget 1.0, I thought that to be a bit of a limitation, because the question for me was to say, what exactly informs the budget if the medium-term development plan is approved after the tabling of the budget? So from an economic planning point of view, there's already, in my view, a disjuncture there. And I think secondly, A couple of years back, Status rebased the calculation for the GDP figures in South Africa. And based on that rebasing, some of the estimates that we noted is that it therefore meant that in order to have gross fixed capital formation that is above 30% per annum as a percentage of GDP, would need around 700 billion rands per annum in order to achieve 3 to 5% GDP growth. And so I think these numbers consistently highlight the importance of a coordinated, well-planned economic sort of system in the South African case.
Yeah, I fear, unfortunately, and this is just my view in Demiso, I'm not convinced that we're going to get one from a coalition. But anyway, a question for another day. We know that platinum prices went down. That brought down mining. There were other factors too, I think. Manufacturing also came down. What was happening there?
In the manufacturing space, we've also seen it primarily being related to the structure of the South African economy. When we look at the data that has come out in this instance, we saw that the primary sector is what, in essence, drove the growth activity or the marginal growth activity that we've seen. And tertiary and secondary sectors were really muted in this instance. And this is where the manufacturing sector in particular is located within. Now, when you also overlay that particular result with the fact that manufacturing accounts for about 13% of South Africa's economic structure, it then explains why that decline in the manufacturing sector led to such a low or marginal economic growth in the past quarter. And so these factors then are accumulated in terms of whether or not our prospects going forward in this particular sector are likely to improve the GDP outlook in terms of the forecast that we model. And in this instance, of course, given what is happening in terms of the inputs into manufacturing from a geopolitical point of view, it then creates a very sketchy picture in terms of whether or not we're likely to see better numbers in the near future.
Obviously, we would like to think that things are going to change. I mean, from what you say, that seems very, very unlikely. Apart from agriculture, I'm going to get to that in a sec, but are there any other sort of bright spots here?
Well, we've seen, of course, the transport sector and, of course, finance and business services having positive contributions. This, again, when we look at these contributions in the context of the structure of the South African economy, the structure of the South African economy is largely driven by finance, personal services, and trade. And so that's why in this instance, their marginal contribution resulted in a slight sort of increase on a quarterly percentage change point of view. It's simply because they are one of the biggest contributors to the GDP calculation in this instance. And so that also, I think, when it comes to, again, to the idea around economic planning, it then raises questions or opportunities around what can the South African economy do to optimize the strength that it presently has in terms of a services-based and knowledge-intensive economy, and how then do we overlay that with sectors that you've highlighted, such as manufacturing and, of course, mining, in terms of having advanced sort of value adds in those particular sectors, because already we do have the services and the knowledge intensity in order to increase the value add in those particular sectors. And so I think those kinds of inquiries would then provide a much brighter prospect in terms of growth.
The agriculture sector's production was up by 15.8%. Now, there was more rain during the La Nina period. Still, in Demiso, I mean, a dramatic increase. And we have had some questions around the numbers around agricultural production before.
Indeed. I think even Stats SA had alluded to some of the limitations that were associated or that impacted the survey for the agriculture sector in particular. The extent to which these numbers might be affected by those limitations are not necessarily quite clear. But of course, I think over the last 3 years, when we've seen an adjusted decline in terms of the allocations to Stats SA, these implications were, of course, anticipated. But of course, agriculture has been a strong sort of driver for the South African economy. Even at the peak of COVID, we've seen its contribution. And again, it falls within the primary sector in the South African case. So for me, what is interesting is that we do have strong drivers in terms of the primary sector. We have strong drivers in terms of the tertiary sector, given what we've highlighted around services and finance. But the secondary sector, which is an opportunity for growth, is certainly where we're not seeing that activity. And that's typically where we see the high GDP growth and the high employment multiplier growth as well.
And Demiso Kubeka, thanks so much. Chief Economist at KH Research Equity Partners. Let's hear now from Thabile Nkunjana, an agricultural economist. Thabile, good evening to you. Agricultural production up 15.8% according to Stats SA. Let me ask you the same question I asked in Demiso. Do you think that figure is accurate? It's a very high number. There was a lot of rain during that period, but still.
Good evening to you, Stephen. And the listeners. Yeah, so the numbers, given that there have been some recent questions, around that data by Stats SA, but I think even if you are to look into, the one point that you alluded to, that is the favorable rains, that has added to it. And also, if you are to look into other activities, if you're looking even exports, we have seen a dramatic rise in those over this past, few months. And that is something that would probably be adding on this. And given that we also had quite a difficult season that year, so these numbers perhaps are closer to what we think should be the truth. But of course, there's always some small room into the statistics and all that. But I think for now the numbers are pointing to the relatively right direction. But of course, we're gonna always try to check the background if there are any things that are questionable. But as it stands now, I think we should be fine.
Karan Beef today confirming it has at least one case of foot and mouth disease, and it's feedlot in Heidelberg, that's in Gauteng. Normally when this happens, there'll be quarantine, perhaps even the slaughtering of herds. Foot and mouth, we know, very serious in this industry.
Yeah, Stephen, this one is quite a hard appeal to swallow, given the scale that Karan Beef operates on. Given that it's not only a big player in South Africa, it is quite big, in the continent, because it also encompasses some of the countries that are around us where they source some of the products. So even those countries, should this thing persist, they are already somehow going to be able to feel this this effect. So it remains quite an issue now, given that even from the data sources that I was just looking on, first quarter we've seen quite a good performance on export. But should this continues like this, remember, China has already banned our beef imports as of early last month. So this now, given that the Karan Beef is one of the bigger players, then this puts all that into jeopardy as things stand now.
Thabile Nkunjana, thank you, the agricultural economist. Do appreciate your time on the Money Show. Let's hear from government now. The Deputy Director General for Agricultural Production, Biosecurity and Natural Resources Management is Dipepenene Serage. Dipepenene, good evening. Good to talk to you again. Are you going to impose some kind of quarantine measure in response to this outbreak?
Good evening to you, and thank you very much for having us. Definitely the Karan Beef that you've spoken of, the feedlot, is currently under quarantine, and so that we are able to get into the place and investigate what could have happened and trace backward and forward so that we can get to the origin of the virus that hit them.
Normally, we have foot and mouth outbreaks in Limpopo quite often, in the Eastern Cape quite often. If it's in Gauteng, how worried are you for the neighbouring provinces, and particularly Limpopo?
We're extremely worried. Like you correctly said, we expect foot and mouth disease to occur in the areas of KZN, KwaZulu-Natal province, the area around the Mpolozi Game Park. We expect foot and mouth disease to occur around Mpumalanga and Limpopo, the areas that are neighboring Kruger National Park. We've got what we call in those areas a protection zone, which means animals around the border or that are nearing that area have to be vaccinated to ensure that the virus does not spill over to the inland, the other part of the South Africa. Gauteng is of a serious worry to us because it shares border with the Free State, with Northwest, and the Mpumalanga and KZN. So that's the biggest of our worries. But we hope that we should be able to find the reason as to why Gauteng. We've had challenges sometimes in the end of late last month, where we had there were reports of possible FMD outbreaks in and around the eastern part of Gauteng. And so we're extremely worried, but we've already taken measures to ensure that we kept the virus so that it doesn't spread.
There's always a bit of an argument when you impose quarantine in some places. In the Eastern Cape, for example, it's very, very difficult to do. People walk livestock back and forth between farms owned by the same family. In Gauteng, is it a bit easier to impose a quarantine than it is in some other places?
Gauteng a little bit easier because then you've got predominantly township and there's very few the animals, pigs, goats and sheep and cattle in the township. But you'd be surprised. Some parts of Israel do have animals, and that's the area. Those are the animals that got us worried. You have some areas that have got animals, you have Renacheng and the Val and all that, those other places, and some part of Israel. So those get us very worried. But of course, it's a bit easier to deal with Gauteng as opposed to if it were to be in a rural area like Limpopo and Northwest. We've had challenges dealing with it in the Eastern Cape, where you'd have a myriad of challenges from people who don't even understand what you're talking about when you talk of the disease management area, and to ranging from people who are just passing animals from one area to the other. You've got the lobola, you've got a lot of those other challenges. Luckily, Gauteng doesn't present those complications.
As I understand it, we're waiting for vaccine stocks from Botswana now. They've had a similar strain there, so it would make sense they have stocks on hand. We will probably need to produce some here, permissions, research, etc. Are you going to try and speed that up?
Yes, we've actually ordered 73 million worth of vaccines already in the late April, early May. It's just that it takes time to produce. So we are expecting a shipment of vaccines from Botswana, but this shipment was aimed at addressing the outbreak that is in the KZN area. So we followed up with another order of vaccines so that we can cover the area of Gauteng. That was before we knew of the Karan Beef feedlot. So yes, we do have capacity in the country, which we are ramping up. The Agricultural Research Council Veterinary Institute used to be able to produce vaccines, but owing to funding challenges and all of that, they lost that capacity. That is the capacity that we've started now. We're finalizing the processes and we've ordered equipment.
Right, we seem to be losing you there, unfortunately. Dipepenene, thank you very much indeed. Dipepenene Serage is the Deputy Director General for Agricultural Production, Biosecurity and Natural Resources Management in the Department of Agriculture.
The Money Show.
The Markets.
Anthony Modasani is Senior Equity Sales Trader at ABSA CIB. Anthony, good evening. Good to see you. Valterra, some of us will still call it Anglo-American Platinum in our sleep. They're rebalancing their stock loss quite a lot today.
Yeah, so thanks, Stephen. Always good to be here. So Valterra listed, they had the name change last week on our market, and on London Stock Exchange, they listed yesterday. So you're going to have a couple of index events taking part this week, which sort of explains this pressure you're seeing in the stock. So the FTSE rebalance is happening tomorrow in the closing auction, and then you've got the MSCI rebalance that's taking place. Valterra won't fall part of the developed market indexes, and that's why you're sort of seeing this selling pressure, and that should probably continue into those rebalances taking place tomorrow and Thursday.
This would all have been expected when all of this process was planned and mapped out. It's pretty common, right?
Yes, no, 100%. Well flagged to market participants, and everyone's sort of aware and in the know about it. It's obviously just the extent and how much selling pressure does come through in the end of it all.
Quite a lot of pullback in miners today. And that very aggressive earlier in the week. And I know there's a lot going on around trade. We all know why. There's a conversation we expect later this week between the US President Donald Trump, the Chinese leader Xi Jinping. Is that still going to have an impact on gold?
Yeah, absolutely. You saw when we came in yesterday, you had gold miners up 10% right in the sky. Once
unbelievable, unsustainable, frankly.
Well, that's what we said a couple months back, right?
Yeah.
So, here we are. So that's sort of what drove the early positivity, the early caution in terms of the gold price moving higher. This pullback today again was just a bit of like, let's rebalance our expectations. But the market is showing that there's quite a bit of caution and angst, as we head into these talks. It's not even confirmed. The White House just said it's in the works. I read just now that Treasury Secretary Scott Bessent is talking about saying China, it's in their own hands if they want to be a reliable trade partner or not. And it's just the US's stance, right? It's stable, and then it goes a little bit on the offensive again. So, having those sort of comments float around does give the market a bit of anxiety and want to stay long the shiny stuff.
What's going on at MTN? They're up nearly 4.5% on the day. Seems that something's happened in the Ghanaian market.
So very exciting. Ghana and Nigeria. That's really been bolstering the market at the moment. I'll kick off with Ghana. Their CD, the Ghanaian currency, has been one of the best performing currencies year to date. Now, why, you may ask? What are their biggest exports? Gold and cocoa, right? And whatever
wow.
those things.
Chocolate and gold. Let's move. Yes.
So, that's just been really positive for them. And, you've seen what that means for MTN Ghana, the company there. It says translated into positive earnings, which obviously feeds back to the holding company now, and that's fed through positively. And it's the expectation of, well, what happens if there's more room to run there? How does that feed through? The other part is MTN Nigeria. That story's been really positive. We get into a point where you can almost see that maybe they're perhaps going to pay a dividend, MTN Nigeria, and that'll be positive for MTN Group as well. So MTN Nigeria and Ghana both contributing positive, and that's feeding through into the share price.
Anthony Modasani, thanks very much indeed. Senior equity sales trader at ABSA CIB, bringing the time on the Money Show to 6:30.
Travel is more than just ticking off countries. It's about the people, the culture, the food, the moments. I'm Pippa Hudson, and on Wonder the World, I invite you to join me every week as we explore destinations both near and far, with the help of fellow adventurers who share their unique travel stories. Listen to my podcast wherever you get them.
The Money Show.
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
And DSTV channel 856.
Probably the biggest political story in Mzansi this evening is around Floyd Shivambu, who famously left the EFF. We had a very long association with its leader, Julius Malema. I remember reporting on the two when they were back at the ANC Youth League. Floyd Shivambu now being removed as Secretary-General of Umkhonto we Sizwe by the party's president, the former president, Jacob Zuma. This all goes back to that still quite strange trip to Malawi where he met with the person who calls himself a preacher, Shepherd Bushiri, and everything that's happened. Bushiri, of course, fighting extradition back to South Africa after literally skipping the country after being arrested and released on bail. But you did not have to be a political genius to know that the personalities of former President Zuma, Dr. John Hlophe and Floyd Shivambu were never going to be able to work together. Really, we all knew this. It was just a matter of time, and it's slightly boring when your predictions actually come true. It does underscore something else, though. At a time when we have a coalition government, and that coalition government is unable to grow our economy as we saw today, just 0.1% in the first quarter, it does show you how important a good, strong, and occasionally principled opposition can be. An opposition that can say, this economic plan isn't going to work, this one will. Now, look, an opposition is not going to make the economy grow, but it is going to put a government under more pressure to make the economy grow. And maybe the Floyd Shivambu story this evening shows us one of the problems we have in our society at the moment, which is that we do not really have a constructive opposition that is actually making points and putting pressure on a government to do everything they can to move the needle on economic growth.
702. Stephen is on X.
At Stephen Grootes.
Well, several months ago, back in April, you might remember we had a conversation with the Chief Commissioner of the International Trade Administration Commission, Ayabonga Cawe, about their plans to charge fees for people to apply for permits to import and export goods into the country. It would be the first time Itac has charged fees. He explained then that they needed more money to modernize the commission, and this would allow them to do that. The Commissioner, Ayabonga Cawe, is back with you now to explain the fees. Mr. Commissioner, good evening. Mr. Chief Commissioner, excuse me, good evening. I do appreciate the time. Firstly, for an import permit or an export permit, the application fee would be 339 Rand. What does that actually buy you? What do you get?
Good evening, Stephen, and good evening to your listeners. And I guess promise is a promise, because I had said when we issue the guidelines, we'll reach out to yourselves and come to you and explain. Mm-hmm. And I guess in terms of the question you're asking on the import and export permits, well, really, I think the guidelines go into a bit of detail in linking the prices for the different authorizations to the processing costs associated with that. And as we spoke, you and I, in April, I'd indicated that really this is about really splitting, I guess, the cost or processing cost of these authorizations for specific regulations of public goods between the taxpayer broadly and, of course, in particular, those who would use these. So in a sense, the system we've had for the longest time has been the entire tax base by parliamentary appropriation to the Commission, effectively underwriting these costs. And I think as those costs have escalated, the appropriations have not been able to catch up. And now a certain portion of that fee will now rest with those who are applying for that authorization. And in the case of imports of prohibited, restricted, and controlled goods, that's the amount you would have to pay. And similarly, if you are looking to export any other goods that can only be cleared by furnishing an export permit from Itac to the customs officials, you would similarly have to pay the same amount.
Okay. Why would costs have escalated? Shouldn't it be cheaper now to process applications, which are effectively just information? Shouldn't it be cheaper than ever before to process these things?
Well, probably not, Stephen, because you would imagine, I think, with the advance and evolution of the economy itself and the series and set of considerations, the process would change. If you look at the list of prohibited and restricted goods we had in 1993 and you compare it to the list we had in 2023, you will realize that there has been the addition of other goods there, informed by our being a signatory to certain conventions. And similarly, you would also have goods there that would have come into play in the post-apartheid period. I mean, let me give you one example. You did not have, in 1983, cellular phones as a consumer good.
Sure.
And of course, at that stage, you certainly would not have had even a tariff subheading that would place those under control, such that you would have a permit. And there are many other typical, either durable, wage, or consumer or capital goods that would have joined that list in the intervening period, and similarly now adding, I guess, to the burden of processing these authorizations, which is a combination, as you would imagine, Stephen, of human personnel task time in addition to processes. And I think a big part of the challenge we've had is that a lot of our processes have not caught up with some of the developments technologically or otherwise, precisely because we don't have a CapEx budget. And the reason why we don't have a CapEx budget is because for the last while, we have been reliant on one part of what should be funding us. And we certainly have not explored to the point of execution the other part, which is to prescribe certain fees for certain processes.
No, that does make sense. There are other categories, and I did look through the guidelines. I didn't have as much time as I would have liked to go through it in detail. But these are categories with higher costs: EPC, PRC, and CSP. What are those? And I'm presuming PRC doesn't stand for People's Republic of China.
Well, no, it would not, Stephen, and I certainly know you would have read it as that. Nor does EPC stand for Engineering, Procurement and Contracting in the engineering space. These are, in the case of the EPC, a eligibility certificate, and in the case of the production rebate certificates, those are also certificates that are given to automotive assemblers and producers, and similarly with the company-specific percentages. So these are authorizations that someone gets in order to be certified as someone who's benefiting under our auto-industrial program. We then have to do a verification, Stephen. And you can imagine the travel costs associated with that, because our regulations do not allow us to just do that 360 virtually. We have to go onto your plant. We have to check your tooling. We have to make sure what you have said to us in your written undertaking corresponds to what we see at a plant level. And all of those things incorporate a significant amount of other incidental costs that with the appropriations we are getting, we are finding it's rather difficult to skimp on some of those costs at the great risk of some of the work that we are doing.
No, sure. I mean, that does make sense. There's quite a long list of exceptions. Some of them are to do with which country they come from, because I presume partly because we're part of the Southern African Customs Union, there may be other reasons. Part of them are because there's sort of regulations under other things. Part of them may well be, I presume, because of relationships we have with other countries. It's quite a long list. It must have been quite a thing to draw it up. And I mean, there'll be lots of different considerations for each exemption.
Well, look, this is our job, Stephen. Unfortunately or fortunately, it comes with all of these complexities of things we signed on to and ratified. We've tried to find a balance in this process, Stephen. We're not out here to try and kind of maximize billable revenue. That's not what we're in the business of. And you will have seen some of the exemptions are for non-profits. Some of the exemptions are for individuals or non-profit generating firms. And some of the exemptions are also where the Commission might exercise its discretion and deem it in the public purpose or public interest to furnish an authorization without expecting to levy any fees. And as you've mentioned, some of them arise from the agreements we would have. But those ones that you've noted there are also listed there so that we're able, Stephen, to distinguish. Not all import permits are for import-controlled goods. Some of those goods that might be levied a fee might end up being double charged if we don't go to town with some of these exemptions. Let me give you an example. If you want to bring in a tire into South Africa, a new one, to assemble into a vehicle made in Kariga, in what used to be called Itac in the Eastern Cape, that might require an import permit, right? But similarly, it might also, that tire, be covered in the other declarations you might make under the APDP, which is our auto industrial program. So a lot of those exemptions, we've gone to town to clarify that if you are importing that tire as an OEM, we're not going to double charge you for that. We're not going to say you now need for the tire on top of the broader components that you would have also had to pay for under, say, kind of eligibility certificate or even a PRC. We're trying to rationalize it in that way so that at least the incidence doesn't fall in a double manner on some of the same set of firms here.
It all sounds, Ayabonga, incredibly rational. Which
well, I guess that's what the promotion of administrative justice expects of us. We kind of have to get to a rational decision, but also, Stephen, we have to put it before the public.
Sure.
You know, we can't sit in a corner and say, Ayabonga Cawe sat in the corner, kind of decided we're now going to pay, nearly 6,000 Rand for a production rebate certificate. We have to clarify that. It's our obligation to do that in line with the WTO, which says you're not going to put fees on these things if they are not commensurate with the processing costs associated with that kind of authorization. And so we kind of have to dot our I's and cross our T's here, but we hope that the public will take the opportunity that we've given them here to comment on this over the next while. And we look forward to receiving some of those comments.
So some people are going to be very interested in this. You are prepared, of course. What I'm getting to is you are, and you have to, I suppose, by law, you are prepared to change your mind if someone makes a strong case one way or another.
Well, indeed, yeah. If someone makes a compelling case that says, well, actually, what you're doing on a rebate permit of charging 4,454 is counterintuitive, because the whole point of a rebate is to reduce the unnecessarily cost-raising effect of a tariff when you don't have the domestic production, and you cannot justify that on the base of the processing costs because or whatever other argument someone might make. We have to engage those arguments, and we cannot take a dogmatic view that says, well, because we have these powers in the Act, we must do so. We have to come into it with an open mind. But I think we are saying what is not in dispute here is actually the complicating factors arising from the macro-fiscal situation that is creating a very difficult challenge for regulation that all of us here, whatever our different vantage points, would agree that it is regulatory instruments and authorizations that we need to have, or else it might just be a free-for-all at all of our ports in terms of bringing in hazardous material and other goods that might be undesirable to have in the country.
Chief Commissioner, thank you. Ayabonga, do feel free to come back to the radio profession anytime.
I'll take you up on that offer. I'll consider that. Thank you.
Thank you. Ayabonga Cawe is the Chief Commissioner at the International Trade Administration Commission. 4 minutes now to 7.
The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking. ABSA is a proud lead sponsor of B20 South Africa 2025.
Well, amid all of the difficult news around the economy and everything else we so often talk about, it might just be time well spent to reflect on how the rest of the world sees us, especially post-Oval Office, etc., because there was an auction of South African bonds today, and it had the strongest demand, the highest demand for them in the last 3 months. 3.75 billion rands worth of bond was on offer. In the end, there were bids for 17.85 billion. Lots of reasons as to why this might be, partly, and I think this is important, as sort of what I would call a technical reason, because people are expecting South Africa to have a lower inflation target, which would basically mean we would have lower interest rates, and some investors would be particularly pleased with that if they're buying our debt. There is also, of course, the fact that we're now past the kind of difficult budget phase, if I can call it that, where the DA and the ANC have finally agreed, and for the moment, at least passed a budget. And I saw that along with that, the High Court today also pretty much threw out the EFF's application to remove the fuel levy, to increase the fuel levy. Good. There's no way that was going to fly. But then I think there are other things too. And one of them may just be, and this is not necessarily such a positive reason, but the rest of the world is in a very, very difficult space. And we, as the JSE keeps reminding us, balances itself. We're balanced partly because of gold. That really helps. But just a reminder of how the rest of the world sees us. Maybe things are not necessarily as bad as sometimes they look. I say that now. Don't forget to listen to Warren Ingram in about half an hour's time. You're with The Money Show at 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking. ABSA is a proud lead sponsor of B20 South Africa 2025. Good evening. Welcome to the second hour. I'm Stephen Grootes. Lots to come on The Money Show. Really, I think an important conversation with Warren Ingram in about 20 minutes from now in personal finance, talking about things that destroy your wealth. So often he talks about how to increase your wealth, but things that destroy it. I think that this really is going to be an important conversation. And I would suggest that particularly if you have younger people in your life, maybe you send them the podcast when it's up. It's usually up, Peter, about 5 to 10 minutes after it ends. We do call them speedy fingers for a reason. But you'll be able to find that. Just literally Google Money Show, Warren Ingram, Destroy Wealth. You'll find it by about 10 past 8. And you'll be able to send that to someone in your life who you think needs to hear it. Would actually really be an important thing to do, I suspect. Coming up, we will talk about greenwashing. I'm sure you've heard of it. Find out a bit more about that. Rutendo Hundingri will be talking about what's happening on our continent as well. I think some important considerations there. And still reflecting in a way in my own head around the fact that our economy just doesn't want to grow. And there have been lots of pieces and lots of analysis and Harvard and all the rest over the years as to why this happens. But in the end, it's because there is not an enabling environment for growth. And you'll know how many conversations we have with small business owners, how difficult it is, what they need to do. We just don't seem to be a place where it's easy to grow and create jobs. And there are lots of reasons for that. Some of them are very deep-seated. Some of them, well, could not be fixed by clicking fingers, but could be fixed perhaps with a lot more political will in one direction or another. Be good to hear from you on this on 011 883 0702 021 446 0567 and voice notes this evening on 072 702 1702.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app
and DSTV channel 856.
The green economy? Yeah, Peter is on the desks tonight, as you can hear. Well, you've heard many companies claiming over the years that they're going green, that they're financing this renewable project or that solar project or whatever it is. But you'll have to forgive some of my cynicism around this, because there is, of course, the phrase greenwashing. Basically involves companies that are able to claim all sorts of points or rebates or whatever for using greener technologies or supporting greener technologies, when in fact they're not really being entirely honest about it. Tracy Davies is the Executive Director at Just Share. Tracy, good evening. Am I right to be quite cynical about this? I mean, is it possible to say that companies really are doing what they claim to be doing?
Hi, Stephen. Well, no, I don't think it's possible to say that across the board, but I do think that there are some companies that are worse offenders than others. And you generally tend to find that those companies which have a particularly high carbon footprint, for example, or a particularly high impact on nature and the environment, or some kind of serious social impact, are the ones that are better at spinning than at executing. And I suppose that to some extent that is to be expected, but there certainly is a heck of a lot of spin out there. Although, of course, that's not to say that there isn't. If we're just talking about renewable energy, so of course there are lots of ways to greenwash and to talk yourself up when you're not really doing what you make it sound as if you're doing. There is a lot of investment in private sector renewable energy, whether it's embedded generation or large-scale renewable energy development. But I think it's important to know and to understand that just because one is investing in renewable energy, or trying to put solar panels up on your car park roofs, doesn't mean that everything you're doing from a sustainability point of view is hunky-dory.
You're often a shareholder in companies that you look at, but I mean, is it possible to get enough information to determine what companies are really doing? Is there enough information about that in the fine print of company reports and things like that?
There is a lot of information in those reports, and if you take the time to really engage with them, then there is a lot of knowledge that you can gain about what they are doing and what they are not doing. But you have to read those reports with a critical eye, and you have to know what you're talking about. You have to have a good contextual knowledge of the industry and of sustainability issues generally. I think that what is perhaps more depressing than what they put in those reports is how little interrogation there is of those claims by, particularly when we're talking about listed companies, by their shareholders. And I think, if you want a really, really strong example, we recently had Sasol announcing at a Capital Markets Day a completely revamped emission reduction roadmap, as Sasol likes to call it, with a whole bunch of new plans, completely different plans to the ones they announced 4 years ago when they first introduced an emission reduction roadmap. And really, you don't have to be a rocket scientist to see the gigantic holes in those plans and the myriad ways in which Sasol is trying to kind of paper over those gaps. And yet we see very little interrogation, if any interrogation, by the corporate sector, by institutional investors, of whether those claims are really feasible and what the gaps are.
Are people, literally putting their hands over their eyes deliberately? They kind of want to believe the almost fiction, and they want to believe it because they've got, boxes to tick, or they've got bonuses to make, or whatever. This is the fear, isn't it? When it comes to investing, you're supposed to be critical. You're putting someone else's money somewhere, usually. When it comes to this, maybe they're deliberately not being as critical as they should be.
Yes, 100%. And I think in Sasol's case, that is an extremely accurate description of affairs, because I think investors are so tired of what's happened at Sasol in the past 5 or 10 years that they really just will kind of cling on to any good news, whether it's credible or not. I find that strange, but that seems to be the way the market works. I think, to be honest with you, there's as much greenwashing in the investment industry as there is in the companies that asset managers and institutional investors are investing in, because, you can pick up the annual report or the sustainability report or the stewardship report of any big pension fund or big asset manager in South Africa, and there will be reams and reams of pages dedicated to how seriously they take sustainability and how robustly they engage with the companies they're invested in to make sure that they are doing all the right things. But you only have to look at the outcomes on the ground, which haven't changed in 10 years, to know that the extent of that robust engagement is actually quite weak. And I think there's also a very cozy relationship, a very interconnected relationship between investors and corporate management in South Africa. It's a small group of people. They're all mates with each other. No one wants to upset anyone else. And so when it comes to really holding people accountable for greenwashing, or any kind of washing for that matter, there's a reluctance to take that battle on. And so it's left to, small NGOs like my own, who have 1 or 2 shares in these companies, to really ask the questions. And just to give you an example, we're in the middle of a kind of extensive AGM cluster of AGMs at the moment, annual general meetings, and we go to every single one of them and we ask questions at every single one of them, specifically designed to call out these kinds of greenwashing issues. And at almost every single one of those AGMs, we are the only person asking any questions. Perhaps there might be 1 or 2 other small investors, but none of our big institutional investors are publicly taking these issues on.
Sure. It reminds me of tobacco companies. Go through their annual reports and look for a picture of a cigarette. You probably won't find one. There'll be all sorts of other things. Yes. My other concern around this is that the US, or certainly the Trump administration, is moving away from supporting greener technologies. And that's the one economy that can put a lot of pressure on in this space. The EU is not really moving away. But I just worry that perhaps there won't be as much, and the sort of investing culture of the US perhaps is sort of changing along with it, and I think we can see that in some ways. And that might just remove some of the pressure for companies, even South African companies, to become greener.
Look, the US is that shift by the US is a problem, and there's no doubt that it will create incentives for companies who have a lot of engagement with the US, whether it's via exports or services or whatever, to hide or dial down efforts they might be making in that regard. But I think it's important to remember, first of all, that many of the kind of sustainability issues that form part of this sort of world of that we're talking about here are entrenched in South African law, whether it's transformation, diversity, inclusion and transformation issues, whether it's, we've now got a Climate Change Act, we have a Carbon Tax Act. So there's a pretty strong regulatory foundation in South Africa for being a sustainable investor. And remember, being a sustainable investor or operating sustainably as a company is not just about doing something to appease the greenies. This is about long-term value creation. Are we creating a world in which we will be able to retire with ease, or are we systematically destroying the foundations of the world and the economy that supports us? And so that's what sustainability is about, really. So we have a strong regulatory foundation for South Africa for these issues in South Africa, but also, the EU is an enormous trading partner for South Africa, and there are enormous pressures coming from the EU in terms of the carbon intensity of products that they import from other countries. There's even pressure, believe it or not, coming from China. China has adopted a new set of sustainability reporting guidelines, which is going to make it much harder for companies doing business with China to ignore these issues. So I think that the momentum behind this is pretty unstoppable. It will inevitably encounter some hiccups as a result of the Trump administration, and we may see some regression. But I think enough smart people have understood that this is a business imperative, not just some nice to have. And so I think it's unlikely that we're going to see a complete reversal.
Tracy Davis, really appreciate the time. Thank you. Executive Director at Just Share.
702 with Stephen Grootes.
Email him on stephen@702.co.za.
Time to catch up on what's happening on our continent now. Dr. Rutendo Hundungi, the founding director at Tribe Africa Advisory and author of Rumble in the Jungle Reloaded, joins us. Rutendo, good evening. Good to chat again. An interesting deal between Ghana and the UAE. They want to spend $1 billion building Africa's biggest innovation hub. What are they going to be doing with the money?
Where there's money, there's always opportunity, Stephen, and a good evening to you and to your listeners. So Ghana is not the first time, Stephen, just to give some more context. You remember a few years ago, I think it was around 2018, Google invested as part of their $5.8 million invest in Africa, an AI factory in Ghana. So Ghana seems to have a regulatory framework and environment or policy environment for private-public partnerships. In this case, it's the UAE. They've invested $1 billion. And the innovation is led by DP World, the company that actually owns PCFC and G42, which are part of DP World. And the focus is in line with President Mahama's vision to develop or to scale up 1 million coders in Ghana. So from an Africa perspective, we know that with our burgeoning youth unemployment rate, and also by 2040 or 2050, 40% of the world's youth is going to be here. Such skills will contribute not only to Africa, but in terms of providing outsourced skills from a global skilling perspective. But the UAE, another partnership between the UAE and Africa, specifically Ghana. And if you also recall, Twitter had a regional office there before Elon Musk came on board and downsized that office significantly. So they've definitely got something right, even though they've got economic wars that attracts tech companies in terms of investing in Ghana, Stephen.
It's fascinating to watch it happen. Ethiopian Airlines, a great success story. They're looking at maybe buying 20 regional jets. And these are always a big investment, no matter how you look at it.
Not less than $1.6 billion if you look at the average cost of those jets. But they're looking at buying, if you look at the kind of brands, they're buying E2, which is Embraer, and A220s, which is the Airbus, and 737 MAX 7. What's driving that is that they've probably got a fleet of at least over 150 jets. And they say they're having growing demand. So this is been driven by demand. They see the investment as worthwhile. Ethiopia, again, if you remember, I think early last year, Boeing announced moving its headquarters from South Africa to Ethiopia. So they've got also definitely, in terms of their not only regional expansion, but international expansion, they've seen a lot of opportunity and value for money. So another key story to follow through. And when we look at the ACFTA and with regards to free trade of people and goods, obviously airlines play a key role, and they've invested in probably one of the biggest hubs on the African continent as well. So another great story with regards to infrastructure and industrialization contributing to economic growth.
It's very interesting. There's a very interesting deal involving Egypt, and they basically are buying French wheat. There's a lot going on around Egypt and its relationship with Europe at the moment.
Yeah, Stephen, I was actually quite fascinated by this story. I didn't know at the time, but just following that headline story, Egypt per annum probably imports about 5 million tons of wheat. And the average price of wheat is probably about $250 per ton. So when you look at this in total, you're looking at about $1.2 billion. They just focus on importing wheat, and it's in line with the big bread subsidy that is part and parcel of the government initiatives. In this specific case, it's a partnership with France. They're importing about 180,000 metric tons of wheat from France. And apparently this demand and supply between France and Africa was actually aligned to Algeria. But Algeria is going through some economic challenges, so their demand is dropped. And France, at the same time, was quite keen to, obviously, a surplus, and they wanted to push out. And Egypt was able to negotiate quite a strategic deal. Look, we know that bread is an absolute key component of diet in the African continent, but I didn't know to this extent. Other key competitors that supply and compete with France in terms of supplying the northern African countries is apparently Russia and Romania. So it's not about guns and weapons, but it's also, for once, it's about food when we're talking about Russia. So another interesting story, Stephen, which just with regards to a key trend in terms of importation and exports on the African continent.
Very, very interesting. There's a story around, and it's been a huge story. I mean, US aid has basically been closed, so there's no aid from the US coming to Africa. And the diaspora, the African diaspora, are looking to a different kind of investment model, a way of trying to make up the difference.
Stephen, I think out of all the stories, this one excited me the most because for a number of times I've highlighted how I think for the World Bank is estimated for 2024, the total diaspora remittances came to about $100 billion US. And these are African people in foreign countries sending money home in one way or the other. So the Africa Diaspora Network based in the US has stepped up and partnered with Myriad USA, which is a grant maker. And their focus is to say, let us use innovative financing models. So whether it's blended finance or other innovative financing models to be able to democratize the philanthropic giving of diaspora money into the African space, with a special focus in terms of stimulating and injecting that into social entrepreneurs. So in other words, they're saying let's harness this capability of remittances, which is quite disparate at the moment, and focus it in terms of using it and working with a grant maker in terms of stimulating entrepreneurs. And for me, that's a big thing. Why? Because I think the World Bank estimates of the $100 billion US remittances that comes from the diaspora coming into Africa, year on year, it's exceeding the remittances of both ODA, that's developmental aid, as well as FDI remittances every year coming to the continent. So with obviously key donors like the USA pulling out, this is going to, if this does work out and the model does work out, it's innovative finance, it's blended finance, time will tell, then it's a crucial solution in terms of the potential challenges with regards to financing and investment. So I think it's something to watch. The vision, Stephen, is to raise about $1 million in collective diaspora funding that would provide matching grants up to about 25,000, and they're willing to start it. And people who contribute $500 and more from the US will also get tax subsidy. So it's got all the bells and whistles. It's making the right sounds. It's solving the right problems. It's innovative. The question is how sustainable is it? And that's something to watch. I'm definitely excited around the story, Stephen.
Fascinating. Thank you very much indeed, Dr. Rotendo Ndungi, founding director at Tribe Africa Advisory, author of the book Rumble in the Jungle Reloaded. A lot going on. Fascinated to see what happens with those jets going to Ethiopia as well, to Ethiopian Airlines, I should say, rather. Bringing the time to 7:30.
The Money Show.
Personal Finance with Warren Ingram.
This personal finance feature is brought to you by Indwe Risk Services, because the right insurance starts with a conversation. It starts with hello, Indwe. Well, personal finance tonight, the weapons of wealth destruction. Warren Ingram, as you know, co-founder of Galileo Capital and certified financial planner, joining us now. Warren, good evening. I suppose in a way we're talking, you spend so much time telling us what makes us money, and yes, diversification, but what you're talking about is the things that cost us money, the mistakes we make along the way.
If you bring up diversification again, Stephen, I tell you, I'm going to start talking about journeys.
Or resilience.
Or resilience. So let's reach out and grab this dripping roast. I think when we talk about money and we look at the big mistakes that people make, I think the mistakes that draw our attention would be those really catastrophic, really poor decisions, often launched globally when people have invested a lot of money, for example, in an Enron or a Steinhoff or something like that. They're really attention grabbing. And we would spend time and effort on them and try and learn from those mistakes and educate ourselves to avoid them. Unfortunately, those aren't the mistakes that cost most of us our ability to generate enough money to get to financial freedom. In this instance, I think the mistakes are almost a death by 1,000 cuts. It's little incremental mistakes we make day after day, week after week, month after month. And at some point, we get to mid-career or midlife, we look around and we start to ask ourselves, where's all the money gone? And where are my investments? And what have I done? And I didn't do anything major wrong, but I'm going nowhere from a financial perspective. I feel like I'm treading water. And to me, those are the big weapons of wealth destruction we need to learn to avoid. It's a bit like those little drones that are getting used by the Ukraine. They can be very effective at causing harm when you use lots of little bad decisions day after day. And those are the things we're talking about tonight.
Okay. There's some obvious ones, and I presume the first obvious one is around buying new cars. Now, I noticed the wording. It's not about buying cars, it's new cars.
Yes, and I almost want to say it can't be obvious because we as South Africans buy so many new cars every year. We do it relentlessly, and so. To me, I think just understanding that there are a couple of decisions that we're making around that. One, we're buying, just to understand, a new car loses somewhere around 10-15% of its value when you drive it off the shop floor. So for context, you buy a R1 million car, which it sounds like an enormous amount of money, but again, we sell lots of these in South Africa, and as you drive it off the floor, it's worth 850,000 rand, and it's not even traveled a kilometer. And it takes a long time for most people to save up and build up investments of 150,000 rand. And then to top it off, we don't really buy those cars cash. What we do is we borrow money. Sometimes we borrow at prime plus 2 or 3 or 4% to buy cars brand new, and we drive them off the floor, and then we're told that we have to have plans. We can't keep this car for 10 years because they need to be looked after and serviced, etc. And so we're kind of encouraged to rotate our ownership of those vehicles from somewhere around every 3 to every 5 years, and so we make our problem much, much worse. We compound that problem because we now have financed that car for 5 years and potentially we've paid down some of it, but then we trade it in, and to be very honest, it's a very good, very usable car that could be probably driven for 10 or 15 years, but we trade it in and then we repeat the mistake again. But now the car's not worth R1 million, it's probably worth 1.3. And so suddenly we're losing 200,000 as we drive it off the floor. And to me, it's something. I guess I'm challenging the word obvious, because if it was obvious, why do we keep doing it? And we do it en masse all the time, year after year.
It is something you notice. I noticed the car market has changed slightly and is no longer just sort of smart, what I would call executive cars, but is also SUVs and things. But the moment you have a family, you start to think you need to spend money on those, and the same lesson would still apply. There's another issue that can happen, and it's so tempting, is that you're told you're going to get a bonus, or you're told you're going to get this, or you kind of anticipate a promotion, you expect that this is going to happen, and so the money's not quite in your account yet, but you're kind of very tempted to spend it.
We do it a lot. We would say, it's the start of the year, and it's been a tough kind of kickoff to the year. I deserve a holiday, and not judging, you probably do. But the point is, you should pay for that holiday with cash. If you pay for that holiday on your credit card, so you fly now, pay later, it might be a very kind of nice, fulfilling thing to do right now, but you're spending money you don't have, and it could be a bonus that you get paid that you're anticipating, and then the question is, companies, especially big companies, very often change their mind. If they haven't contractually agreed to a bonus and it's written down, if they're just giving an indication, unfortunately they could change their mind. Circumstances could change. They could be a big export business to America and suddenly they can't export anymore, and you don't get your bonus. Or you could be just earning a salary and saying to yourself, well, I've got a job and I know I can pay off this debt over the next 6 months, which might be true until perhaps you don't have a job because your company shuts down or you get retrenched. So we do this quite a bit as well, where we spend money we simply don't have. And we in fact, what we're doing is we're borrowing it from the bank, and very often on our credit card at 25% interest or 24% now that interest rates have come down, and then we're paying it off. But gee, you lose your job or you don't get the bonus and you can't pay it off, and suddenly that money is growing against you at a rate of about, it doubles almost every 3 years if you're paying it off at 24% a year. So this can be an enormous mistake, in a very short period of time, especially if you do this regularly.
I mean, there's a lot that you need to be very careful of. I mean, it's really about, and this sort of takes us to another point in a way, short-term debt. So it's very easy to have short-term debt. There are often things that you want to buy. There are often things that you're very interested in. How seriously do you need to be careful of that?
Well, let's stay on the point of paying off your credit card debt at 24% a year. And if you do a quick, calculation on Google or on an AI engine, and you ask it, what happens if I've got 100,000 rands worth of credit card debt and I don't pay it off, within a 3-year period, it goes to 200,000. And so the thing about credit cards is, I was speaking to someone over the weekend who said, I haven't even seen my credit card. I haven't pulled it out of my wallet for a very long period of time because it's so easy on my phone now. I just tap wherever I go and it's all done. Or I just do the online shopping. And so it's become incredibly easy to spend money and much more difficult to keep track of actually what we're doing with that money. And so, short-term debt, when we're borrowing money from the bank to buy things like clothes, shoes, whatever it is, accessories, those things have no value. If you try and sell it the next day, you're going to get very little money for that. And so if you're borrowing money to buy things that have no value, you might be doing small amounts. You might be doing small transactions, and you think, well, that's really not such an expensive item. It's only 2,000 rand, and I'll just service my minimum on my credit card. It's not really a problem. Well, congratulations, you've got the item. It's got no value. You can't sell it again. And if you're servicing the minimum, the likelihood is that 2,000 rand item is going to cost you 4,000 or 5,000. And if you're doing it regularly in very small amounts, it doesn't take long before you're at the point where you owe hundreds of thousands of rands on a credit card. And you made no one big mistake. You just did little bits here and there, month after month, year after year, and you've got nothing to show for it. You've got no assets to realize where you can sell them. They haven't grown, faster than the inflation rate. So you've gone backwards in effect by doing those small little behaviors every single day.
I think there's a thing, and I understand this. I mean, we all feel that we work hard, and that's because, generally speaking, we do. We work very hard. If we're lucky enough to have a job, we're working, sometimes it feels all the hours in the day. Certainly by the end of the week, you're exhausted, you want to relax, you want to maybe go out with friends, things like that, and you want to live a certain lifestyle. And the aspiration of that is fueled by all sorts of things, advertising, what people around us are doing, all of that. And I think we feel that we deserve this. Does that get us into trouble?
I often do talks to companies, especially their youngsters when they're starting out and the new professionals, the newly minted professionals. Let's not name the careers because this isn't naming and shaming, but I'll walk around their parking lot, for example, in their parking garage, and I'll see all these enormous cars that are being driven by the senior people. And then talking to the juniors, immediately that's the aspiration they have, is we've arrived because we've got a qualification, we're starting off our first job, we studied for 5 or whatever it is, 6 or 7 years, we've got postgraduate degrees, and we've got some letters after our name now, and we need to show the world that we have arrived. And the examples that they are given are their peers, but more importantly, the older people in the business that have been around longer, and so they tend to spend as if they have already arrived, as if they're already earning those big salaries, because they feel they deserve it. And it's not just to the professionals, to be fair. A lot of the time we feel if we've been working for 3 or 5 years in an early stage in our careers that we're no longer juniors, we need to move up and step up and show up and all of those things. And so we adjust our lifestyle to what we expect it to be, what we think it should be. Unfortunately, money doesn't work like that. What arrives in your bank account after all the deductions is the lifestyle that you can afford to live, and wishing it to be different, unfortunately, is not going to make it different. If you want a different lifestyle, you need to earn more money, and it sounds really simple, but we do this in really little small amounts. We don't do this as one big step where we go from living in a 10,000 Rand a month rental apartment to living in a 10 million Rand house. We step up gradually. Every year we do something where we spend a bit more because we feel we should. And if you're earning a lot more and you spend a bit more, well, that's the way to go. Well done. That's living within your means. But unfortunately, our income almost never rises as fast as we think it should. And then spending according to what we think as opposed to what we have is a classic mistake that a lot of people make. And if I'm sounding clever, Stephen, as if I've never done this, these are the hard lessons of life that I'm sharing, and many of them my own, but also watching everyone else's as well. So if you're listening, I empathize. I've been there. But the point is, the people that achieve financial freedom, they are good at not making this mistake. They are good at living within their means and finding ways to save. And that's the trick here. Is you need to take control to get to the point where you can live the lifestyle you want, which is matched by what you can afford.
There's so much to it, and so many sort of scars from it, to school fees and things, and they're very expensive. 011 883 0702 021 446 0567. We're speaking to Warren Ingram. Your questions for our personal finance guru this evening. We do have a question from Joseph. Joseph is asking, Warren, I want to buy shares myself. What is the best way to do that? We'll have Warren's answer for you in a moment.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking. Absa is a proud lead sponsor of B20 South Africa 2025.
The Money Show.
Personal Finance with Warren Ingram.
And time for an answer to Joseph's question. Joseph's asking, Warren, I want to buy shares myself. What is the best way to do that? And I imagine, Warren, there are quite a few ways to do that.
The choices available now are quite wide, and so for Joseph, I would say there are a couple of things. One, there are quite a few good online platforms that allow you to buy shares or even fractions of shares, and that means that you could buy shares with as little as 50 Rand or 100 Rand at a time. And a lot of the banks offer platforms via your banking app where you can buy shares direct on your app, and so it does become quite easy for us to buy individual shares. And I think the things to focus on will be costs. And understanding what you're going to pay before you kickstart is really important. So the two sets of costs to be aware of. The one will be if they're charging you, and most platforms will charge you a transaction fee. So you just need to understand how much are you going to pay to buy the share that you want to buy. And that's not just the price of the share, but it's the transaction charges as well. So if the share costs 50 Rand a share, how much, and usually you can see it on the platform before you start. They'll give you some kind of a quote to say the transaction will be 50 Rand plus another 12 Rand, for example, in transaction charges. So just to understand what those transaction charges are, and then also be aware that it's not a once-off cost, because you will pay that same cost again or possibly more when you decide to sell your shares again. So when you're buying shares, your transaction fees, you need to be very careful of them, and understand that when you trade in small amounts, the transaction fees might be a fixed Rand amount. So in other words, they might say, we're going to charge you 100 Rand for every transaction. And if you're trading, 500 Rand, then a transaction fee of $100 is 20%. Don't be confused by the small Rand amount. Make sure you understand the percentage charge. And you don't want to pay 20% as a transaction charge, because you would be thrilled to get growth on your shares of around 20% over a 1 or 2 or 3 year period. And so all of your growth could be eaten up by costs. So understand that as your first cost. And then your second cost will be any annual fees that you'll be charged. So do they charge you a monthly account fee? And is it a rand amount or a percentage? So I think online is best, and doing it via a platform, either through your bank or a well-reputed online platform, makes a lot of sense to me. Do your homework, look at all the reviews, and then do your homework on what to buy. Don't trade on what everyone else is telling you to buy. Do your homework, make sure you understand why you're buying the company that you want to buy, and you can't just buy it because it's going up in price. You have to buy it because you believe it's got some kind of compelling reason that it's going to appreciate in value over a 5 or 10 year period. So buy what you know, buy what you understand, and then give it a go and do the homework and be patient.
Is it a good idea to trade shares yourself when there are lots of professionals out there who are supposedly better than us, and lots of index funds which over time might well have a good track record?
I think you're right about the index funds. I think that they offer a really compelling advantage for a lot of us as private investors, where we can simply buy the market and enjoy the growth of the market. And very few professionals, it works out to sort of 2 or 3 out of 10 are able to beat the index over a long period of time. However, what we have as an advantage as private investors is time. And so if you've got a particular insight, let's say you're a phenomenal computer game programmer, and you understand that there is a company making games that's way better than everybody else, and you've got deep inside knowledge about the way games work and where the industry is going, then buying shares in something that you know well could be the advantage that you have over everybody else. But if you're a computer techie and you're buying platinum shares because you read a headline yesterday, well, I'm sorry to say that's a terrible reason to buy shares. So it is about making sure you've got deep knowledge in a specific area and using that knowledge to your advantage, and then being really patient, because sometimes the market is wrong even though you're right. So the price might go down for a while because people are worried about Trump or tariffs or trade barriers or whatever it is. But if you're patient, perhaps that thesis that you had about why the share will do well, perhaps that unfolds over a bit of a longer period of time. And so you can be patient because it's your money and your objectives and your knowledge.
Warren Ingram, always good to talk to you. Thank you very much indeed. Personal finance, of course, this evening with Warren Ingram.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
US markets beginning to turn up after a mixed open. Of course, huge concerns about what might emerge out of that conversation between President Xi Jinping and President Donald Trump. But it seems, once again, NVIDIA is bringing the market up. You can understand on the metrics why they would be doing that. The Dow is up nearly 0.6%. The Nasdaq's up a full percent. And the S&P 500 up 0.71. Where will it all end? Well, of course, you'll find out on this radio station with Matteo tomorrow morning. And there'll be a lot more on The Money Show tomorrow evening. It's just gone 8 o'clock. Good night.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking. Absa is a proud lead sponsor of B20 South Africa 2025.